welcome everybody. Thanks for joining us here. If you're looking for innovative solutions, you came to the right place. And clearly in this market, which is not yet flush from a financing perspective, I think these are all things that are top of mind for everybody that's at this conference about, how to find ways to really bring more capital into the business in what can still be a challenging environment valuation-wise and otherwise. So first we'll start, and I'll introduce myself. I'm Nicole Brookshire. I'm a capital markets lawyer. When there's a good market for IPOs and when there's not, we're going to talk to my panelists. Brendan?
Hi, I'm Brendan Carroll, one of the founders of Victory Park Capital. We provide asset-backed private credit primarily to growth businesses around the world.
My name is Amy Ola. I'm the head of Canada for CIBC Innovation Banking. And we provide a variety of venture debt products to companies across North America that are generally SaaS enterprise type focused. We have 10 offices in Canada and three offices in Canada and 10 offices in the United States. And we have one office in London, England.
And good afternoon, folks. I'm Amit Verma. I'm with the Australian Securities Exchange, more commonly known as the ASX. We're a global top-tier exchange with over 2,000 companies listed. Some you'll be familiar with from the US, including Block, Inc. and Life360. The total market cap of our exchange is it's over $3 trillion. And I'm looking forward to spending a bit of time with you all later today talking about why it makes sense for some types of US companies to list on the Australian Stock Exchange and how some of our tech companies have a 4 times higher valuation multiple than some of their like-sized US counterparts.
Wonderful. Well, let's kick it off. Brendan, you made a very prescient comment in an interview in 2021. He doesn't remember, but luckily I have evidence out there. I don't think this new business environment will change the need for traditional banking products or services. It may help banks get more efficient or add different products to adapt to the current desires of the customer base, but I don't think it will replace them. Since Brendan gave that quote when the public markets were literally pouring capital into companies' coffers, the financing environment has radically changed yet again. But your axiom around the need for traditional banking products holds true more than ever. Mid-2022 through 2023 were very quiet years for both debt and equity financings. Now that we're sort of knee-deep in March in 2024, can you just sort of set the financing landscape for us and sort of what your take is right now on the funding environment?
Yeah. So we provide debt facilities that businesses need to operate their business model day to day. We're not providing venture debt or buyout debt. You could be a e-commerce business that needs inventory and receivable financing. You could be a lending business that you don't have enough of a track record yet or scale to go get a facility or securitization done. So as you've seen a constant growth for needs-based financing, banks typically aren't providing it to the average consumer. So we're seeing more and more businesses have that demand. I think the biggest change is for that 10 years of venture capital flowing very freely where rates were close to zero, you didn't need our capital for more than 2 or 3 years because you could then graduate, per se, to more traditional debt. Now, like my high school age children, everybody wants to take a gap year because those equity markets are still not the same. Companies that maybe would be able to move on from us after 4 or 5 years of life are staying with us 6, 7, 8 years because they're not getting public or they just don't have the same sort of growth metrics, but they need that same debt to operate and improve it day to day. So I would say on average, we're seeing larger businesses in the same industries that we've always focused come to us because the securitization markets, cost of capital, et cetera, is requiring them to do so.
That makes sense. Amy, same question to you. How are you seeing the funding environment?
So the general lending principles, I don't think they really waver too much. However, we are seeing more companies come to us with very little runway. And so that can make it harder to finance them, given we're trying to ourselves finance to their next event. And so for someone like, for our group, we're looking for companies with probably minimum 9 to 12 months of runway before we're able to layer on, which I hope, if I'm doing my job well, I'm layering on likely another 12 months of runway with the goal to get them out of the market that we're in currently.
Makes sense. And Amy mentioned that you're in Canada.
Yep.
So are you seeing, is the sort of the dynamics, the macroeconomic dynamics that you see in the United States, or is it the same in Canada? Or is there any sort of like geographical differences there or macroeconomic differences there that you're seeing from a funding environment?
Yeah, so generally we parallel the US in a lot of ways, but I don't think I have to tell this audience the biggest difference is volume. Like for example, there was $7 billion of equity that went to approximately 600 businesses in Canada. That's like peanuts compared to what happens here in the US.
Right.
But I will say that Canada's matured in a lot of ways, and so there's a lot of VC and PE interest coming into Canada and keeping us very busy, particularly of late. I saw in Q4 and Q1 of 2024 big pickups, particularly around exits. So a lot of smaller PE funds coming in to have to do a buyout of a software company, and that's where we'll maybe step in and help with a management buyout with leverage and kind of put a nice piece of debt alongside whatever they're trying to buy the business for.
Excellent. Brendan, you have extensive experience in the private credit market. Can you provide, not everybody necessarily knows what that means, so could you provide a little context, sort of that versus venture debt? You mentioned that in your last comment, to just give a little bit for the non-experts in the audience. What type of products are those, and what are sort of the types of issuers or companies that could be seeking those products?
Sure. When we first started in 2007, we closed on our first fund mid-08, about 45 days before Lehman Brothers collapsed. Everybody says now.
Congratulations.
Thank you. Everyone
Crushing
says
it again.
now is the golden age of private credit. I guess we can debate that. But for what we do, I know for sure that 2008 was the beginning of asset-backed private credit, because you saw a combination of banking pulling back, regulators stepping in, and an influx of growth capital like we'd never seen. So you saw businesses transitioning from traditional brick and mortar models to online or digital, whether it was e-commerce or lending, insurance, what have you. And these companies, as I mentioned, need debt to operate day to day, but you could have the safest asset in the world, but if you're an enterprise that has less than 5 years, CIBC or Bank of America or Wells Fargo is not going to give you that capital. So we provide debt to businesses that, again, just need it to operate day to day. Difference between that and venture debt is lending more against an attractive enterprise value on a business. Typically there's equity or warrants attached to it. There's a higher return profile. So if I have a portfolio of 30 companies, I don't want to lose money on any of them. We're in the basis point business. In venture debt, some losers can be offset by the warrants on some winners. And then what I still see is the largest area of private credit is buyout financing, right? The capital that's used when private equity is making an acquisition, a dividend recap, et cetera. So our capital is used day to day to manage the business. And again, everybody's using our capital to show that they can graduate and scale and cross the chasm, so to say, to a more traditional capital structure.
So when you think about it, just to maybe set the stage maybe around whether it's ARR or it's valuation, I mean, because you're talking about capital.
We have
businesses.
A borrowing base, and
okay.
Depending on what the collateral is, will determine how much we'll lend against it. If you're Square and you're lending $1 to the local coffee shop, 8 years ago we were their partner, we'll put up 85 cents. Okay. But maybe after a year or two, you've proven your model, we're comfortable, maybe 85 moves to 90.
Yep.
So there's a lot of different factors that come into play. How much capital do you have on your balance sheet? How much runway? What's the duration of the collateral?
Right.
But you're looking at it from a borrowing-based perspective, very different than lending against enterprise value.
Okay. And obviously, taking us back through the history, you know, and we've obviously also cost the transom vis-a-vis the interest rate environment.
Yeah.
Like, as the market has matured in private credit, like, what dynamics have changed? Anything other than maybe interest rates?
When we started in 07, and I would walk into endowment, pension fund, sovereign wealth, whatever it may be, most did not have any private credit in their portfolio. So you're educating on the asset class and then trying to convince them that they should choose you within it.
Right.
Fast forward to today, most LP types that we deal with around the world have private credit in specific areas within private credit as part of their daily allocation models that they're constantly looking to allocate to. It's not going away,
Right.
so to say. That's a big change. Obviously, it's brought more people in, but it's more of a mainstay in anyone's portfolio who's looking to buy the world.
Got it. Amy, from your perspective, has there anything in terms of what's market changed, whether it be from the bank perspective and for the private market perspective? Any further thoughts vis-a-vis that and what you've seen in your business?
Probably the biggest thing, like we would talk about size, the quantum of a deal. In 2021, 2022, we were hearing, leverage up to 3 times ARR, which was quite excessive. We didn't do that, but there were private lenders that were getting up into that range. It's come back down.
Yep.
And, I like to think, I always start, that for our businesses, a good range to look at is starting at 1 times ARR is a healthy amount of debt for a business. And now, do we go to 1.5 times debt to ARR, or do we come down to, 0.8 times debt to ARR to figure out if that makes sense? So with that has come also, the pendulum has swung back into the favor of the investor. And that also means if it's in the favor of the investor, it's also in the favor of me. And so covenants have started to go back to, I say, pre-pandemic levels of, they actually are targeting something. So they're forcing a milestone event, whether it's break even, or some sort of.
Can you get a little bit more into those details? Like, is there a timeline on that? How do you guys think about it?
So there's certainly, most of our transactions, the terms are between 4 and 5 years in length.
Yep.
And so obviously we're going to allow a business. Now, so for venture debt, true venture debt, early stage, Series A, Series B, we may not see the transition to break even. But we want to see
You hope for it.
It would be lovely, but it doesn't usually happen.
Right.
But we would like to see a plan,
Okay.
and I think everyone's tracking to that plan a little more closely. So if your ARR isn't tracking as planned, are you making adjustments to your EBITDA levels, your EBITDA burn levels? And on the flip side, for growth deals, you're seeing very similar, where they're actually forcing, okay, we'll give 2 years.
Right.
They're break even right now. We'll give them 2 years, 3 years to get on track to become EBITDA positive.
Got it. And just flipping back to you, Brendan, and as you in the private credit arena, are you more covenant light or
No, we're very covenant heavy, and because it's borrowing base driven. We
Right.
do delayed draw term loans. So if we commit $100 million to a business, maybe they can only draw $20 million on day one based on
The
whatever the
milestones you set
collateral is or whatever we're lending against.
Got it. Okay.
But over time, as they're adding new eligible collateral, they can then draw additional capital from us. But it's very, very restrictive around what that capital is being used for. If you are a point of sale financing business operating in the U.S. and now all of a sudden you want to operate in Australia, you're going to have to come to us and we're going to have to look at the data around that product to say yay
Right.
or nay. So it is extremely restrictive around what the capital can be used for. But what the trade-off, I guess, for them is if they grow and the collateral grows, they know they're going to have as much runway as they need.
Right. And question for both of you, from an industry standpoint, are there, and I think you talked a little bit, Amy, about like SaaS, like software business, but are there any particular sweet spot industries that you would say you feel like your business, like there's a great melding between the companies and sort of the product that you're offering?
We do a lot in fintech, and if 10 years ago, if Lending Club or Prosper were novel in terms of they got your information no different than a bank and did direct mail, and that's how they found you as a customer, but they don't know what you're using the money for, things of that nature, to today where you have specific needs-based financing where you know exactly whether the customer is using it to get their car fixed or to pay their rent. When you know what the use of proceeds is for a consumer, the predictability of the underwriting is way more accurate. So you're just seeing further advances in terms of customer acquisition, putting a walled garden, so to say, on what capital is being used. And to us, a consumer loan made by American Express versus a company that started yesterday is still a consumer loan. So we know how to structure it, underwrite it, service it if need be. But if you're a newer enterprise, it just doesn't matter what the interest rate environment is. Without that longer track record, you're not going to be able to access traditional capital. So we think we're being overpaid for the risk we're taking lending against a consumer asset.
Got it. What about you, Amy?
So we're definitely industry agnostic, but with a focus on recurring revenue. So we love SaaS for that reason.
We all love SaaS.
It affords predictability in the budget and looking forward. But that being said, we'll break down it by revenue line. So you're just not going to get the same leverage off of, say, hardware versus, which is more working capital intensive.
Right.
I'll probably looking to leverage some of the software associated with the hardware. And then we'll also give credit where it's due for transactional business, but again, it's not going to be at the same leverage level.
Right, much more
so
complex.
we'll adjust accordingly, yeah.
Makes sense.
Sense.
Amit, we're going to totally pivot, and we're going to talk about a different ways to raise capital. So in the U.S., as an IPO lawyer, it's been a slow walk back to the IPO markets that we had in 2021. And with 2022 and 2023 in the U.S. being at really historic lows, what's the investor sentiment right now in Australia for going public? And I know we'll get a little bit into sort of what the mechanics are around that, which is super interesting.
Sure, and certainly it's right to have the ASX on the panel that talks about innovative solutions for fundraising. Well, in Australia, the high-level summary is that the market is open, right? With a bit of a nuance there. So it's almost like a coin with two sides. On one side, you've got the IPO market where companies that have got a successful track record, they're large, off-scale, profitable, they can list anytime they want. We've done 3 or 4 quite big listings recently. Newmont for 68 billion, Light & Wonder for about 8 billion. We did Arcadium for 11 billion. This is all from the US coming to Australia. And this is quite recent in the last 6 to 8 months. The other thing that's definitely open is the follow-on raisings. We are by far the #1 venue in the world, far ahead of the NASDAQ and the NYSE as well, in terms of volume of transactions and follow-on raising. We do over 1,000 transactions a year, just the way the market is structured. It's very easy to raise follow-on capital. In a couple of days, you got money in the bank. It's that easy. Now, where the nuance lies is where I'm talking about new IPOs, is companies that unprofitable, they may have raised in 2020 and 2021 at significantly higher valuations, which have not readjusted. For those types of companies, the windows may be a bit more trickier than your traditional, more profitable businesses. So that's what I mean when I say the market is open for certain types of companies. Now, this is all driven by, we've got quite a unique situation in Australia where the small country of 26 million people, we have the 5th largest pool of money on the planet sitting in that country. It's $2.5 trillion sitting in our pension industry, looking for a home to be invested. Now, a lot of that money finds its way into listed equities on the ASX, either by mandate or by preference, because these folks prefer an comfortable Australian regulatory environment. They prefer an Australian dollar quote that they understand well. And they've asked us essentially to go out and grow the menu of companies available to invest in. So we're talking growth industries like technology, healthcare, life sciences, not just from Australia, but from across the globe, that they're keen to look at and they're keen to invest in. They do invest offshore as well, but they do prefer to invest in listed assets on the ASX in Australia. And the sheer weight of this money in Australia also causes something that I mentioned earlier in my intro, that increase in valuation as compared to US companies. So on average, our technology companies in our technology indices, their multiple, EV to forward sales revenue multiple, is about 5.5. Now, to access those kind of valuations in the US or a little bit higher, you need to be in the S&P 500, which is an entry point of nearly $16 billion. If you look below that, the S&P mid-cap and small-cap infotech, their valuation multiples are 1.5. So that's a massive cliff that the US companies are facing if they're not in the S&P 500. Similar size companies in Australia, the average size being sort of 2 to 4 billion, their multiple, as I said, is 5.5. So you can access those higher multiples in Australia, driven by the superannuation money that's just waiting to be invested in these businesses. So we have that demand scenario, which is driven by that scarcity factor, really. And I'll touch on a few more things later as well, yeah.
So I have to ask a question.
Yeah.
How much time do you have to spend in Australia if you want to pursue this strategy?
So you don't have to be present in Australia at all. Of course, you can remain a US entity. We accept US GAAP accounting standards. We don't ask you to convert to IFRS. You don't need to re-domicile your business. You just issue what's an instrument known as CDIs. It's similar to ADRs coming the other way, but a lot less complex. It's fairly straightforward. In high-level terms, it's about half the complexity and half the cost to list a company on the ASX as compared to listing it in the US. We make it very easy. Your SEC, we accept your US reports, US audits. We don't ask you to do anything too special. And certainly if you're above $2 billion Australian in size, then we have a category called foreign exempt. So if you're hypothetically listed in the US, you can dual list really easily on the ASX as well.
How do you sort of reach your investor base that's there, and how do you get analyst coverage? How does
Correct.
that work?
Very good point. I was going to come to that. So we've got S&P run indices as well in Australia. Our flagship index is the ASX 200, S&P ASX 200. The entry point for that is only 730 million. And the next level down, the S&P ASX 300, the entry point for that is just 372 million US. So once you're listing in Australia, you access these indices, automatically that drives liquidity, that drives coverage, that drives profile, and that drives the valuation as well. So you don't, yes, you should probably come down to do investor meetings, investor roadshows,
Who wouldn't want to go to Australia?
Exactly. Australia is beautiful. Everyone should come down at some point. But we've got these unique market dynamics and levers and settings that make it really easy to be public at a lot earlier stage than you can probably go here. The feedback that we get from the market is that in the US, you got to be 5, 10 billion plus to start getting any attention. You certainly can list a lot earlier, but then you'll fall into that lower valuation bracket that I just mentioned. And these are not our numbers. These are numbers provided by Bloomberg, so they're probably verified.
Thank you. So Amy, pivoting back to you, you touched on this a little bit, if you could dig in a little bit deeper, but with just the dynamic, the market dynamics having changed, did your lending criteria, I don't have to get into the proprietary stuff, but did your lending requirements tighten? Or the type of businesses, do they need to be more scaled? Do they have to be further along the bridge to profitability in a market that is more constrained from just a debt perspective and an interest rate perspective?
No, so one thing I didn't kind of point out, so I'll lend $2 million to a company that's just raised its first institutional round, seed round, let's say.
Okay.
I'll also lend $60 million to a growth stage business.
Okay.
And then anything north of that, you're usually starting to syndicate, and we'll lead syndications or participate in syndications as well. So it's very, very broad. There's a lot of breadth to the products that we offer. But what's important, I don't need them to be cash flow positive by any means, especially for the venture debt players, but I do need a plan. And the one thing we haven't touched on is fundraising also for VCs. So the fundraising environment has slowed down, and I have a little bit of insight into it since we're a capital call provider, and we are an LP into many funds across Canada and the US, and things have just slowed down generally. You could, in a snap of a finger in 2021, you could raise $1 billion fund. That's not happening quite as easily for funds right now. And so we too are very conscious of the follow-on rounds for the funds, for these businesses. We want to ensure that there's a path to them being able to raise again, and that their investors are supportive, and where are their investors at as well? Like, where are they in their fundraising cycle? That's something else I think we should have.
Makes a lot of sense.
Yeah.
Brendan, you were at the beginning of the private credit market. Like, what are you most excited about in terms of products being developed? Is there anything new that's coming, you think, in this environment, or?
There's always the next iteration of a business model,
Right.
Which again is great for us because back to what I've said over and over, the collateral is the same, but if you're a new business model and a new way to acquire a customer, you're starting that clock yet again. So we're constantly seeing more and more of that. The product set has become more diverse in terms of what private credit managers like us will provide. So whether it's specifically to real estate or e-commerce or different areas, so there are more options out there because back to the LP side of the table, being more comfortable with it, constantly allocating to it, that ultimately will help the end companies because there's more opportunity set for them to get it. It's more well known, it's accepted. I would say right now, it's a lot easier to take on a private credit facility when you know the rates are already going to be high. There's a lot of businesses that obviously are paying significantly more than they were when they signed up. So that part, makes us concerned across the industry, et cetera. So I like new deals a lot better than existing because you're
Right.
structuring around that. We used to have floors on SOFR, now we have ceilings.
Okay.
So that's changed quite a bit. But again, typically we're lending for short duration and call it 3 to 4 years, and
Got it.
companies don't want to lock up for much longer than that.
That makes sense. Sammy, could you just touch a little bit on, obviously we're all aware of what happened with Silicon Valley Bank last year, and how did that impact sort of the sector that you play in and really options for emerging companies?
There's a lot more options right now. So there was a very big competitor at one point, and there's still very much, SVB still very much is in the market and competitive, but we also probably have another 5 debt providers that have come in to the market as well with the exodus that happened from SVB.
Right.
And so it has made, on certain transactions, very competitive. Like there has been times where there's 9 term sheets sitting in front of.
Wow.
And so what that means is relationships with the company and with the investors and with the board become more and more important. But I think that everyone usually finds a lane and finds where they want to do their best and find where they want to lend, whether it's growth, whether it's venture, and that will get sorted out over the next year or 18 months. That's what I kind of predict. But there's definitely a lot of competition right now. And it doesn't help that there's fewer deals. So
Right.
with less raises happening than 2 years ago, there's fewer deals that they're focusing on, which is creating this kind of momentum as well.
That makes sense.
Yeah.
So Brendan, we have to cover non-dilutive financing because it was in the intro to our panel. So could you talk a little bit about what that means and the pros and cons of that?
Well, I mean, non-dilutive in that you're not giving up equity.
Right.
And again, while our cost of capital is not that of a bank, it is cheaper than using equity dollars. And if you're going to scale, typically by the time a company's in normal or more normal environments, by the time a company's gotten to us, they've used their equity capital to prove their model. And then we're sort of that next step before they would then hopefully graduate to more traditional capital. But to scale quickly, having that all done through equity is just very tough to do, very dilutive to do. So that's why, again, even though our cost of capital is in high single digits to low double digits, when you have insurance companies that want that demand, et cetera, it just helps those companies, if they have a collateral-based business model, have a less dilutive way to do it. Also, in times like now, it lets you ride it out a little bit, where you don't want to raise your next round at the current valuation, or the checks aren't as big as they were. If you have a business model that can be cash flow positive without constantly pouring money into growth, this solution helps you sort of ride that out.
Excellent. So Amit, can you give us a little bit of a case study on a successful business that has pursued the ASX as a means of going public?
Absolutely, and just before that, I might just mention something that was very close to what Brendan talked about. Dilution was, of course, listing a company is a dilutive exercise overall. It has some parallels in helping with dilution because in the sense that it collapses the preference stack, so it prevents any over and above excessive dilution that may happen during private rounds, so that everyone basically comes on common stock. But to your question, Nicole, about a good case study, the best one that comes to mind is a company called Live360. It's a San Francisco-based company that listed in Australia in 2019, raised $145 million for a market cap of around $690 million. They provide a family, it's a location-based family tracking software. Fast forward 4 years, they're now a $2.5 billion company, still listed on the ASX very successfully. And the key to understand here is that story about the index inclusion that I touched on earlier. So when they listed, a year after that, they got access into the ASX All Technology Index, which is our smallest index that covers really tech companies. Entry point for that currently is only about 125 million. But then the year after that, they got into the ASX 300. And then 2 years after that, they got into the ASX 200, which, as I said, an entry point of 750 odd million. So that continuous uplift of being included in these indexes at a much earlier stage than US counterparts, kept on driving profile, coverage, and liquidity, and the valuation as well.
Can we just go into that a little bit? It just means that mutual funds have to buy your stock.
Exactly.
So that's so like it
correct,
affects your
yeah.
price.
Sorry, I just assumed folks know what being in the index meant. But good point, yeah. So it means that the exchange-traded funds that are linked to an index or an index-linked fund, they by definition have to buy your stock. That drives the further liquidity into your company. So that company did have public aspirations of at some point listing back in the US. They haven't done it as yet, probably because the Australian market is, providing whatever they need quite happily. They may in the future do a dual listing back into the US at some point. But for now, they're successfully growing, using the ASX as a very stable and strong base to really, grow their store. They're up to 50 million users now.
Well, on that up note,
Sorry?
I said on that up note, which is a success story, we're going to need to wrap up our panel because we're over time. But certainly, thank you to all of you, and please tap into our experts if you have more questions about the products they offer.